Hello, today is Saturday, June 27th. Today's session is titled Stock Market Emotions Out of Control. Let's watch. Hi, my name is Jonathan Gurney, Portfolio Manager at Gurney Financial. Friendly reminder, this is not advice. This is informational purposes only. We're going to jump directly into the charts, try to keep this quick, direct, and to the point. So, the challenge for me as an advisor has a variety of different demographics, different clients in different stages, which we love. We actually enjoy that. Is we have to be able to make sure we can keep things high level for some people, but go deep for others that need to see the deep part. So this is going to be more of a high level, more educational approach today. So we're going to hit those charts and jump into it. Okay, so first of all, emotions are very, very high right now. Why are they higher than they were 3 weeks ago when we saw a 5 to 7% one-day dip? In my opinion, it is because the news is putting out COVID in every headline. That is a common theme. So when I see that, I know that emotions get even more heightened. What's interesting, and this is more of a psychological, emotional behavior investing stat, is essentially that the news actually impacts your emotions more than the price action. In short, Friday was an ugly day, and here's Friday's price action. I mean, that's not a fun day. Now, let's take a look at the month. Okay, this is the bigger picture. Amazingly, the NASDAQ is still positive. So, if I were to show you a chart that shows the NASDAQ is up 40% off its lows, and you see this, a 1 day, that's actually the 1 week, but the 1 day, which is Friday, are you really surprised after a 40% increase? Personally, I think we were running a little hot, which is why we backed off. So in short, the whole point of this is to show, listen, and again, for my clients, this was a down 0.35 at the most. So if I don't like to see losses, but if I'm seeing concerning things on the tape, which I did and will show you, I'm going to back off risk. It doesn't mean I'm bearish. It just means, hey, we're probably due for a dip. We were very fortunate to have a nice rally. When headlines get a little negative, I don't initially sell. I look to see what price action does, and it tried to recover but had a hard time doing it. So to me, that's a sell. Mid and long term, that you do not be bearish long term. So we are just, trying to short term save some money. That's all this is. So keep your emotions in check. That's really the summary there. And just to kind of show you, like, look, the month after a 40% increase off the lows, I mean, that's crazy. I would think we would see more downside, but we have not seen it. So keep your emotions in check is the short of it. Let's go over the charts quickly. Here's kind of the recap. And again, the S&P 500 is a macro perspective. 500 of the largest companies, some of the large cap companies of the United States, okay? There's the summary. Here is the most recent price action. We went as high as 33.93. We got out at 33.80, just saying, hey, it's extended here. We saw put call ratio is extremely high. Good things don't happen when the put call ratio is below 40. And so when I saw that, just like I did here, I took some gains. I don't have a crystal ball, but when certain indicators hit, if a bad headline hits, usually that's the catalyst for a 5 to 7% dip. Doesn't mean it always happens, but the odds are well in your favor when the put call ratio is that low. So again, bottom line, 3 weeks ago, and this is the emotional side of it. This is what interests me the most, is we were here 3 weeks ago, saw a big 1 day dip of 5 to 7%. Second day went down a little bit more and recovered. I honestly did not see a lot of fear in the market here. Okay. I'm seeing more fear on this recent dip. Why? Because it's now in the news, hitting the tape, and people are selling as a result. The 200-day moving average does not hold. The red line right here, that is not a good thing. It's not an immediate sell. I want to keep some on, but this is also not a good thing. We want this to recover quickly, and it could next week. So keep an open mind to that. Don't get too bearish here, because there is $8 trillion on the sidelines, meaning people have a lot in cash. Many people miss this huge upside. I do think by the end of the year we are higher. But would it surprise you? Would it be out of the spectrum to see a 5 to 7% dip from here? No, that's in line. I mean, that's usually what we see every year, especially after a 40% increase. Would that not be reasonable? Yes, it'd be reasonable, but does that mean it's going to happen? It probably won't, because there's so much cash. So I don't expect a big dip. I'm glad we have 85% plus in cash, save some money. We're actually positive on the month, so it's been completely fine for us, and prevented a nice dip and trimmed a little bit. That's what we do. That's how we manage assets. When we see certain indicators, we sell. We ignore we watch the news and see how price action reacts to the news. So it's important to know the news because there's a lot of headlines, but to see how price reacts to it is most important. So last week, this is what we said. Could we test this gap? And it continuously, as you can see, failed to close. That was a red flag to me to say, hey, this is a top at 31.55 for the short term. We said, hey, here's the resistance right here. Here's the support. All of these supports have broken. The 200-day moving average broke. I don't know if it gets bought quickly here or not. I don't have a crystal ball, but I'm watching closely. And which situation would you rather be in? I'm speaking to clients directly. Be 100% invested right now, up here, or 85% invested, 15% invested at this point. That's what we did. We sold on Tuesday. Saw some downside Wednesday, a decent upswing Thursday, and failed to rally on Friday. So we actually did pretty well on managing the risk during this time. Put call ratio. This is what I've been saying. Bad things happen when you get to these levels. Now, this was over a week ago. However, this is very complacent. And to be honest with you, we're right in average. So despite, a decent dip in the last couple days, the fear is not there. So that actually concerns me a little bit to say, hey, it's actually good resilience on the market, but there's just not a lot of fear. There's more fear of missing out. So, which is why the dips continue to be bought. So the last thing that I'm watching is the VIX. The fear index. So the put call ratio, the last chart, is complacency. When there's a lot of complacency in the market, people not hedging, you start to question, hey, can this really go that much higher? Usually it does not. Typically, keyword. VIX. Again, we've been watching. Can this get above the 50-day moving average? Below. We want to see fear decrease. So it's actually still above the 50-day. It tried a few times to get below that. That was encouraging, but it's not consistently staying below that, which is not good. So short term, there are reasons to be a little concerned, which is why we back off. We're not going to be the advisor that says, hey, we'll be fine long term, and we will. There's nothing wrong with that. You will be fine mid and long term. However, if we can prevent, a 5 to 7% dip, that's in our plan to do that. We don't get it right all the time. The good news is this. The QQQ, the NASDAQ, tech companies in general, we're testing the 20-day moving average, which is this gold line. So, in bull markets, whether you want to call it a bull or bear market, that's up to you. During upswings, let's call it that, it tests a 20-day and rebounds. So I would not necessarily get too bearish yet. That's the summary. Here's a really good summary. Historical annual returns 1928 to 2019. Based on more than 90 years of history, 73% of years have been up. You have to understand that as an investor. So, despite me being a little bearish and taking some money off short term, I am absolutely bullish midterm, absolutely bullish long term. This is simply a move to prevent a dip, and it worked. Now I know if it goes any lower, I need to add more because historically, look at this, 73%. So here's the bigger theme. It's interesting to look at this. So I'll let you look at this, but I mean, 19 after a horrible 18. I shouldn't even say horrible. That seems minuscule to what we just saw recently. But it's been a volatile few years. And so if I go back to this chart right here, this is the range we've been talking about for a long time. For 2 years, it's been in this yellow highlighted area. I have not changed this chart. I've kept it the same for several months. I said, I think we're going to chop around in this range for a long time. Not a long time, but a decent amount of time. I think we get out of it much stronger as a result. Downward pressure will bring more of these monies off the sideline and make it a more sustainable move. So I actually like what I'm seeing. I'm glad we're seeing this downside. Momentum names have really taken off. So switching gears here, this is more the educational side. This might be for some people like, okay, I get this, move on. That's completely fine. For those that are trying to learn more new or just need to hear some comfort, here's the summary. Macro, the market will rebound before your emotions recover. Now, it's very easy to look and see that there is a lot of fear out there. I want to reiterate what happened, and I said this before, the market will rebound before the economy recovers. That happened. We saw a 40% rebound. Now we're starting to see kind of a second wave in coronavirus. So I'm bringing this language up again to say, hey, don't expect a massive dip here. If it does, that's okay. We will manage it accordingly, and the market will recover even if the economy doesn't. So if you're playing the economist role, placing evaluations and bets on the market, you're not going to be a good investor because you're going to see the horrible economic data and not understand that the market in many cases will not follow that whatsoever. It's 6 to 8 months ahead of that. If you bring your opinions and political views into investing, you're not going to be a good investor, period. So keep that in mind. So questions that have come to us: have we hit a bottom or will we retest the lows? I do not think we test the lows. The lows meaning this. I do not think so. But could we get in the 2760 range? Potentially. I don't think we even go that low. A 2900 could very well happen. That's very close. And I think people would potentially buy that between these Fibonacci levels, between the 61 and the 50 retracement. So there's a lot of indicators here. We are going to be just adding on the way down so we don't miss it. So don't lose your mind when that happens. So back to this. What indicators are you watching? We watched the put-call ratio, which I showed you the chart of. We showed you the VIX, which is fear levels. It's having a hard time getting out of that range, which is why the market has really been trading in a range. Okay, so this is actually really good price action to say, test lower, see if buyers come in. If they don't, we need to go lower. So this is what I want to see, especially with only 15%, less than 15% invested. So what are you looking for to add new monies? I want to see key levels hold. Right now they are not, so which is why I'm being cautious. Wouldn't you think we should be lower in the stock market? It doesn't matter what I think. It's what the price action shows. So yes, naturally I'm surprised we've rallied this far. But given the news, I'm surprised we aren't a little bit lower, but there's so much in cash, meaning people have so much, are overly bearish on the market, that I don't think we see a big dip. So what do I think we should be lower? Probably a little bit, but it doesn't matter what I think. I have my opinions, but I follow price action, which is why right now the decisions to follow price action has really helped. Wouldn't you think we would be lower given the news? Why aren't we lower? Because there's so much in cash. Really, it's the same question. So I hope this helps. So in short, it's okay to be cautious short term. Never be bearish long or midterm. Clients, we have less than 15% invested. Does this mean I'm bearish? No, I'm actually bullish. However, when I see the put call ratio below 40, which shows complacency, I'm going to be cautious. Okay? And I saw relative strength indexes over 75 on some of the stocks that we own for 2 weeks and we're up 30%. Be a realist. Take the gain. That's my philosophy, and it has worked for me. That's how we have beat the market or the S&P 500. So after a 40% rebound, is it not logical? And in your emotions, should you not be prepared mentally for a little bit of a dip? I think you should be, which is why we took some gains and followed price action. So logically, the market is not logical, but following price action was the confirmation there. Historically poor management, it's stupid to go 100% cash. So I probably will not be selling more than I already have. So could we see another 5 to 7% dip here? Yes, very probable and possible. But I don't expect much. So don't get too bearish. So if you have questions, let us know. The price action is not bad here. The news makes it feel horrible, but we were positive on the month in most indexes. So after a 40% rally, the fact that you're positive on a month with the not so good case count, I think you should be happy here. Okay. So let us know if you have questions or concerns, but if you're watching too much of the news, you're always going to think the market is going to go down, period. That is what sells. Okay. So keep that in mind, that if you're an economist and seeing all the data that looks horrible, the market will view that as, can it get any worse, and probably buy. Keep that in mind. All right, that's all we have for today. Let us know if you have questions. I know these are heightened times, but I hope this helps and it's educational for clients. Again, informational purposes only. Have a great weekend. Bye.